$39,000 sounds incredible until you realize what it actually costs you in the long run. That's the average first home owner grant in Australia right now. And look, don't get me wrong, free money is genuinely helpful. But most first home buyers never do the calculation. They see the grant approved, get excited, and make three massive financial mistakes that turn that $39,000 gift into a $180,000 lifetime loss. This video is going to show you exactly how that happens, which parts of the scheme are actually worth it, and what you need to do differently in the next 48 hours to protect your money. Because your bank's not going to explain this, they benefit when you don't understand it. Let's start with the actual numbers on the table. The first home owner grant is $39,000 to $50,000, depending on which state you're in. New South Wales gives $39,000. Victoria gives $50,000 if you meet the criteria. Queensland does $50,000 plus land tax exemptions. But here's what people forget. That grant doesn't appear in isolation. It's bundled with three other schemes, and one of them is genuinely valuable while two of them are traps. You've got the FHOG, that's the cash grant, which we just talked about. You've got the FHBA, the First Home Super Saver account, which lets you put up to $50,000 into super and pull it out for the house deposit. You've got stamp duty exemptions or reductions, which saves you $25,000 to $70,000, depending on the property value. And now you've got Help to Buy, the new shared equity scheme, where the government takes a 20% stake in your home and you owe them equity later. That's 4 separate levers, and most people pull all of them at once without understanding the cost. Here's the hidden cost most people don't realize. The first homeowner grant is taxable income in year 1. That means the $39,000 gets added to your assessable income. If you're earning $65,000 a year, suddenly you're assessed as if you earned $104,000. You pay tax on that extra $39,000 at your marginal rate. For most first home buyers in that income bracket, that's 37% plus Medicare levy. That's $15,210 in tax on a free grant. So the grant isn't $39,000. It's $39,000 minus $15,210, which is $23,790 in your actual pocket. Now, mistake 1. This is where 60% of first home buyers go wrong. They put the grant directly toward the deposit. Sounds logical, right? Free money for the deposit. But the moment you do that, you're borrowing more overall. Here's the maths. Let's say you're buying a $550,000 property. You've saved $50,000 yourself. You get the $39,000 grant. That's $89,000 in deposit funds. Most people now put all $89,000 down, borrowing $461,000. But here's what happens next. The bank wants insurance because your deposit's under 20% of the property value. You don't actually have $89,000 of your own money. You have $50,000 of your own and $39,000 of government money. Your real deposit ratio is 9%. Lender's mortgage insurance on a $461,000 loan with a 9% deposit. That's roughly $15,000 to $18,000 in insurance costs added to your loan balance. So you borrow $479,000 instead of $461,000. That extra $18,000 gets paid back over 30 years at 5%. That's $37,000 in extra interest alone by the time the loan's finished. Mistake 2 is the FHBA trap. The First Home Super Saver account lets you put up to $50,000 into superannuation and withdraw it tax-free for a house. That sounds amazing because you're not paying 37% tax on that $50,000. You're paying 15% tax inside super. You save 22% right there. On $50,000, that's an $11,000 immediate win. But here's what the scheme doesn't advertise. When you pull that $50,000 out of super at age 25, you're not letting it compound for the next 40 years. If that $50,000 sits in super and compounds at 7% per year for 40 years, it becomes $1.49 million by retirement. So you're spending $1.49 million in retirement wealth to save $11,000 in tax today. That's not a good trade. That's a catastrophic trade. Now, the stamp duty savings. That part's actually real. In Victoria, on a $550,000 property, first home buyers save $30,000 to $35,000 in stamp duty. In New South Wales, it's similar. That's a genuine win, pure money saved that doesn't have a future cost. Use that one. Mistake 3 is the shared equity trap, and this one's got hidden timing costs. Help to Buy lets the government take a 20% stake in your property. You don't pay interest on that share, which sounds good, but you do have to buy it back later at whatever the property's worth at that time. Let's say you buy a $550,000 property and take the government's 20% stake, which is $110,000 of equity. In 10 years, property values rise. That same property is worth $750,000. The government's 20% stake is now worth $150,000. You have to buy it back at market value. You didn't save money, you just deferred the cost and it grew. Plus, that shared equity means you need lender approval to renovate, refinance, or sell the property before you've bought back the government's share. That's a friction cost that's real. Here's what the real path looks like instead. Step 1. Use the first homeowner grant for what it actually does well. It reduces how much you need to borrow overall. Don't use it to go bigger on the property. Use it to borrow less. Instead of buying a $550,000 property, buy a $500,000 property. Put your $50,000 down plus the $39,000 grant. That's $89,000 down on $500,000, which is a 8% deposit. You're over the 15% threshold, so no lender's mortgage insurance. Your loan is $411,000 instead of $461,000. Over 30 years at 5%, that's a $131,000 difference in total interest paid. Step 2. Skip the FHBA entirely. That $50,000 stays in your bank account earning 2% interest, not going into super at all. You've already got the grant. You don't need to sacrifice your retirement to get another tax break. Step 3. Use the stamp duty savings to build a renovation buffer or your emergency fund. Don't use them to increase what you borrow. Step 4. Avoid Help to Buy. It's designed for people with no deposit. If you've got a deposit saved, you're better off using it rather than giving the government equity in your home. What this actually adds up to over the first decade, the average first home buyer following the grants heavy path ends up in a $461,000 mortgage, pays $37,000 in extra lender's mortgage insurance interest, sacrifices $1.49 million in retirement wealth, and potentially owes the government another $40,000 in shared equity buyback costs. That's $1.57, $6 million in total costs created by one grant that sounded like free money. The person who uses the grant to borrow less, they're in a $411,000 mortgage, no insurance, no super aid, no shared equity. Over 10 years, they've paid $131,000 less in interest. Over 30 years, they've kept that $1.49 million in super intact. They're looking at a $1.62 million difference in net wealth by age 55. That's actually the difference between retiring with a paid-off house at 60 and retiring with a paid-off house at 70. Your 24-hour action plan is simple. If you haven't applied for the grant yet, tomorrow morning, call your accountant and ask them this one question. What's my marginal tax rate, and how much tax will I pay on the grant in year 1? Get that number clear. It's one conversation, 15 minutes. You'll know exactly what you're really receiving. Then, run this scenario with your lender. Ask them to quote you on a $500,000 property with a 15% deposit, no lender's mortgage insurance, versus a $550,000 property with a 9% deposit and LMI. See the real difference in total interest over the life of the loan. They'll calculate it for you in 20 minutes. Finally, ignore the FHBA unless you're earning over $90,000 and want to sacrifice retirement wealth. Ignore Help to Buy unless you have zero deposits saved. Use the FHOG and the stamp duty savings. That's the only two pieces of this scheme that actually work for most people. Everything else is financial engineering designed to make you borrow more, pay more tax later, or sacrifice retirement money now. The grant is real, but real money requires real maths. Go and do the maths.